Good morning. My name's Neville Henry. I'm the Managing Director of Winchester Energy. I'm a geologist with over 40 years of oil and gas experience. Winchester was described by Resource Global Network as a junior taking on the Permian heavyweights. I think it's a little bit early, but I believe we have the portfolio, the team, but more importantly, the passion and the drive to be successful and compete in that world. I'll skip through the disclaimer, save a few seconds. The company was formed and listed on the ASX with a single focus on the eastern shelf of the Permian Basin. We focused on that because it was a low cost of entry into the Permian Basin. It had multiple stacked pays and it had been underexplored even at $100 oil, and we were able to pick up a good position in there. It has resource plays and conventional plays. Since listing in 2014, the company has participated in 11 wells, 8 are on production, 2 are drilling and in stages of completion, and we're on our first short radius multilateral horizontal with 4 legs at 500 feet in each direction. That gives us about a 20 times reservoir exposure compared to a vertical well. The primary target has been the Ellenberger fault carbonates. Stay back there. Has been the Ellenberger carbonates, and we have identified a 10,000 acre trap with 15 million barrels of resource potential and an additional 15 million gross barrel resource potential in Strawn, Canyon and Reef plays above it. The company has licensed 3D over its entire acreage set, and that's helping us to define the future drill sites. All plays are very economic at current prices and current oil and gas prices. The company has no debt. Just a quick look at it. We have about 2 million available in cash currently, 250 million shares outstanding, 44 in performance options. Another important point that the founders and management have about 48% of the company. Recently, Strachan Corporation did an analysis on the company, and it estimated our price prior to the recent horizontal drilling at 10.3, with a success case targeted at 50 cents a share. Our company's a little different, I think, than a lot of small Australian companies. We have a strong technical base. More than half our directors are geological or engineering based. We are based in Houston, so I have a technical team, full technical team with land department, everybody based in Houston, and that keeps us pretty close to the ground. On the comments we're making this morning, if you're flying into Midland right now, the flight's about $900. Every hotel room's full, so they're pretty keen in Midland about the future, so they're all working pretty hard there. Costs are really getting high just to visit the town. The company was a couple of key people, myself and Peter Allchurch. Peter Allchurch did form Aurora Oil and Gas, where John and Ian were from originally, and I was the geologist that worked with him and put the Eagleford position together for that company, and as you know, Aurora was probably the best performing small company stock on the Australian stock market in recent years. The Permian Basin, we've talked about that today. Why are we there? It's low cost, great oil, stacked pays. Pretty simple. This is an interesting slide. It shows what happened at the oil price fall. The company, the number of rig counts. Well, we floated about a month before that happened, and there was I think a sentiment that we should put all our money in the bank and, we'll come back one day and figure out where we're going to spend it. We saw it as actually an opportunity. Coming out of adversity, we were able to pick up, quadruple our acreage at 10% of what the acreage cost was. We dropped our drilling costs by 40%, and we renegotiated all of our leases into 5 leases with 1 well a year commitment after the first 3 years, and 1 well per year after that. So we've cut our future drilling expenditure expected wells by 21 commitment wells by doing that. Current technology, we're a big believer in technology. We're using it's an old technology, but it's being reintroduced with some new benefits to it, and we're drilling multi-leg laterals into the carbonate as we're talking about right now. We plan to drill 5 500-foot wells. We've drilled 2 of them in the current well, leg 1 and leg 2. This is the design. So we drill and cut across the key zones, increasing the net feet. In the first leg, we had about 6 meters of possible pay. We end up with 45 meters in the lateral well, and we're currently drilling leg 2. So that's increasing our exposure, as I mentioned earlier, 20-fold, from 100 feet, 30 meters, up to 2,000 feet, or 150 meters in the laterals. The cost, the vertical well costs about $800,000 to drill and complete. These laterals are costing $1.6 million to drill and complete, as I said, with a 20-fold increase. The average rates across several wells is 100 barrels a day, and EURs, the adjacent field called Suggs, over 100 wells, they pulled about 10 million barrels, the average well being about 100 barrels a day and 100,000 barrels EUR. The economics at $45 oil is pretty good, around 80% payout 12 months at those type of rates, but it's transformative when we start looking at the multi-leg horizontals if we get multiple numbers above 200 barrels a day. You know, it's all about profitability. We talked about all the sorts of things that are going on today. Profitability, getting more out of the rock for the same dollars. We're looking at a lot of other technologies, looking at nanotechnologies to improve the recovery, getting more than 10% out of the rock, getting back to 20 or 30% from the rock by injecting nanoparticles in the completion process. These horizontal wells, I'll just go back, one of the other advantages of them are the Ellenberger formation is very heterogeneous, so you can drill a really tight well and you can drill a fantastic well. We've drilled wells of over 250 barrels a day in the verticals and 30 or 40 barrels a day in verticals as well. So by doing these laterals, we believe we get a much higher chance, and that has happened in the first leg, of intersecting fracture zones and higher porosity zones and multiple versions of that down those horizontal legs. Another area we've been really working on is seismic imaging, and we're using inversion seismic processes, and this is just an example of a shallower play called what we've called a straw channel. No wells have been drilled in this channel to this point. Sorry. Where am I going here? So no wells have been drilled. As you can see above in the original seismic, you really can't define very much from it. How do we see the company growing? Well, obviously it's by drilling wells, putting production online, and this has been the growth since we started. How are we going to build our share price up? The main process is put out on production, develop and drill up some of those new play ideas in the next 12 months, and that's our main focus. Convince the market that we really have our 30 million barrels, and that would be about a net to us of 15 million barrels after working interest and royalty, and our net back being basically $25 to $35 per barrel. This is our ongoing drilling program out through middle of next year, and that's our plan, and that's what we're trying to get through, and we believe we'll will be cash flowing very strongly at the end of this program. To recap the Strachan report, and I want to thank you very much for your time and attention today. And I'm sorry this is a really speeded up version of this, but hopefully that gave you an encapsulation of what Winchester is. We have production, we have a forward program, we've got a drill, our finding cost is low, we've got a great team, we've got great ideas, and we're using technology. I think the panel said all of those things this morning, so thank you very much, panel.